Thanks for checking out this video from NetPicks today, and we're going to talk about fixed profit targets. And everyone knows, one important exit you have to consider when you're trading is where are you going to take profits? Just jumping out of a trade, it's never a strong choice. So what are your choices when you're taking your gains? You got a fixed target price, which is essentially a defined price point in the instrument that you're trading. The second is a trailing stop. You're just using a variety of methods, right? This decreases your risk and locks in profit as price moves in your favor. So before we continue, though, let's make sure that we know where you're going to exit if the trade goes against you. Okay, there's one special thing that you got to know about a stop loss when it comes to risk management. So let's cover that. A stop loss, when you place that in the market, it sits in the market waiting to be triggered. And then it gets filled at the best possible price. And what's the problem with that? Well, unless you use a stop limit order, you could face a worse fill than you anticipated. So while you may be expecting to get filled at that black line here, depending on the market and the volatility, you may actually get filled at a lower price, right? So this makes your loss a lot larger than you anticipated. You can check more about stop loss placement at this view here. But the key point is when you know your exit point in a losing trade, you can define your risk in the trade that you're about to take and measure your risk reward ratio, right? So you have to know where you're going to exit at a loss. Now, I'm not going to cover a whole lot with trailing stops, okay? There's a lot of information on our channel about those. But in brief, with a trailing stop, you just find a method to bring your stop closer to price as it moves in your direction. Right, this lets you have your winners run until a big enough reversal takes place to stop your trade out with a profit, hopefully. This is a simple price action method of using a potential support level to trail your stop. Now, if you're in a short trade, you set your stop above a resistance level and continue to trail your stop downwards. So here, each time price movement makes a new high point, you would just bring your stop loss under the last pivot low. The idea is that this pivot low is potential support. And if price does break through it, we could be seeing a correction in the instrument or even a complete trend reversal. When we talk about fixed price targets, this allows you to know in advance the price that you will exit your trade for a winning trade. Of course, market conditions have to be right for your position to make a profit. Okay, this is why having a trading system that has your precise entries, exits, and risk management is vital to have. Okay, not all markets are good to trade, so ensure you have outlined exactly what you're looking for in your trading plan. So we're going to cover three things: support and resistance levels, right? So market structure. We're going to cover reward to risk ratio scale outs and the measured move. Okay, these are three pretty popular approaches. So the first one, support and resistance. So let's use a trending market as our example. And each time price makes a new high or a new low and pulls back, it puts in a pivot level, right? Don't be confused with the mathematically calculated pivot points, right? These are actual price structure levels. So in an uptrend, we can expect that the swing high level could be resistance to a market that's moving up. Now, in this example here, price did blast through it, but it did pull back the next day to test it. So the setup of this trade would be as follows. Price is in an uptrend, and we broke through a prior resistance level. Price pulls back. The former resistance is acting as support. Price pushes below and is immediately bought up on the same day. Your first price target for trade management or your full exit would be the potential resistance at $18.08. That's actually a $2.02 per share potential profit move. And it's no different, when we're talking about short trades. Here, price rallied off support at 93.25 in a downtrend. There's a few entry criteria going on here: a trend line break and an inside candle reversal. And then support holds at 93.26 and then price rejects. So by taking action near the support level, you either banked profits or scaled out and reduced your risk. When we talk about risk reward ratios, now taking profits does not have to be complicated. This is pretty simple. Know your risk and then scale out or you take profits at multiples of that risk. Example, this stock is in an uptrend. There's a pullback against it. Price pulls back to the prior resistance, now acting as support. It's a failure test entry at support and the bottom of a price channel. $1.11 is your initial risk on this trade from entry to the initial stop loss. Target 1 to target 3 are just price targets using 1, 2, and 3 times the risk of $1.11. Now the first potential exit or trade management area would be at $40.56. The one thing to keep in mind is where the multiples of risk land on the chart. So in this extreme example, the price target of 1R, which is 1 times your risk, is above the resistance level. And although price did touch the target here and does pull back, the higher probability is there would be some resistance to new highs to hit your target at that last pivot. And I said this is an extreme example because the setup candle is quite large. The entry point is close to the resistance level already. Generally, my stop on these kind of trades with such a long lower shadow is a little less than halfway up that candle. Why do I do this? The shadow and the red close does not show that bulls really won this battle. They still lost it. The stop is quite large at $6.83. A larger stop would decrease the position size. Also, if you get triggered in and price reverses half of that setup candle, you could be looking at an outside bar, taking out the low of that candle. It's all personal preference, okay? But the point is, if your price targets are slightly above resistance or slightly below support, consider adjusting your target to a price just before that potential rejection level. The measured move price objective. This is a fixed price target strategy, and it actually uses the rhythm of the market to decide your price. Now, markets move in waves of corrective and impulse swings. We all know that. So we would look to enter in a corrective swing, the reversal out of that swing, and look to target 100% of the prior impulse move. So here we see price makes that move from A to B, and that is the distance we're going to use for our next price move. Price does pull back and sets up a failure test support holding entry. So we had support level there, price poked down, was immediately bought back up. So we take the price point from A to B, project it from the low of the candle at C, and D actually equals the same distance in price, the C to D, as B is from A. Now understand this is not going to be exact all the time. Okay, price can and it's going to fall short or exceed your price target there. But what having targets does do is allows consistency in your taking of profits. Now, regardless of what exit strategy you're using for your profits, you have to understand there are certain moves in price that you should be concerned about. Strong momentum against your position is cause for an exit, regardless of your stop loss routine or your take profit strategy. So consider the black line here. That's your ultimate price target. If you see outside bars on the left or a gap up, like long shadows are another sign, you may want to consider an early exit. Now, this would not be a knee-jerk reaction. Price is telling you that for at least in this short period of time, something changed in the market. In fact, these types of candles that show up near support level or resistance levels, just turn the candles around, that can be an entry in a support or resistance holding or failing trade. Now, the beauty of this type of profit taking when you're trading, when we're talking about fixed profits, is it's extremely consistent. You have a routine. Now, are any of these exit strategies better for swing traders? Can day traders use them? The answer is these are not just for any one type of trader. We've simplified a very important part of trading, and we removed knee-jerk emotions out of taking profits. It's a fact that traders let their losers run. It's a fact that they cut winning trades quickly for emotional reasons. But this is not what successful, consistent traders do. When you use a fixed price target with a trade management plan that gives you concrete steps, you take each position that you take with confidence. Okay. This can make for less emotions and a much more healthy equity curve. As always, if you have any questions or comments, pop them below. If you haven't subscribed, please do. Give me a thumbs up on this video. We'll talk to you soon.